Good evening, everybody. My name is Daniel Young, and I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms. And I am back to talk about the stock market and our investment strategy using closed-end funds. So to get the normal stuff out of the way, this is an unedited video, so who knows what you'll hear in the background because I film these in my house. I mean, it's Sunday evening and we're all kind of prepping for the week, so you might hear life happening in the background. I'm not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in a limited company, and sometimes I walk alone, and that's kind of how it feels right now, to be honest. And I'll get to that. So, updates for the week. Uh, Book wise, I'm about halfway through, maybe a little bit past halfway through editing. Um, really working on crafting a narrative and walking through the 12 steps to financial freedom. And the draft is there. And I honestly like using ChatGPT as my editor. I mean, it's not like talking to a person, but in revising a book, it's certainly more direct and timely feedback. So, and I still get to steer it. It's not like somebody else completely rewriting my book for me. It's making me think as I go. Is it accurate? Is it completely accurate? No, it's still got some issues, uh, but it's an interesting experience. So um, I am. Let's see. I'm probably about the halfway point. So I've just hit the 12 steps. I'm about two steps in, and yeah, going along pretty well. The goal, honestly, is to get through about a chapter a day, but sometimes it's 2 to 3 days to really craft it. It's like going through the first draft of anything. It's here's what I want to say, and then you've kind of changed it over time, and um, some days are better than others. So if I can get through a chapter a day, it's an amazing week. Or I guess if I can average a chapter a day, it's an amazing week. But it's really like 2 to 3 chapters a week. So we'll see. Um, the Substack is there, but it's kind of waiting in limbo, to be honest, because I want to finish. I want to finish the book in the break. I want to finish the book in the breakout section. So the it's the 12 steps as a standalone, and then there's a separate closed-end fund section, and there's a separate scholarship section. So I want to get all of those in place and then go back to Substack and work on that. Um, so in the meantime, it's still trying to manage everything else. I've told my wife today, I feel like if I looked at my brain like a computer, I've only got so much, or like the internet, even there's only so much bandwidth or so much RAM. I I'm hoping to cross off some projects this week. I'm hoping to make progress on some projects this week, and thereby have a little bit more mental space or headspace to do some things. So, um, it's just financial organizing. It's stuff I haven't been able to get to, but my goal is to get to that. So, as it pertains to the market, I mean, I'll shift away from me and just look at the data. I was going through the complete update this weekend, and there's some things that are much the same as 2 months ago. I mean, the prices of almost every closed-end fund have changed a little bit in the last 2 months because that's the last time I did a full system update. I was surprised, took me about an hour to do all the basic data. Then I went back through and looked at the dividends, changes there, go back through and look at all the targets and verify all the targets. And so both updating the data and then also making sure they have the right symbol, whether it's one, two, or three asterisks. All told, it was probably about 3 hours of work ish. Um, and as I'm going through the spreadsheet, I was watching the market over the week. Not a lot really changed. And then I get the normal like end of week emails and notice a lot of emails have the same titling, same theme. Consumers are more worried about debt. You've got the job market issue. Um, the bond market disagreed with the rate cut last week, but the average person really wants the rate cut. Um, and then at the end of the week, I took a look at the market and I was like, well, that's just kind of weird. Like I looked at our portfolio on Friday and noticed some things. And then it was hammered home again while I was going through the update this weekend. And well, yeah, we'll get into it. So the bond market dipped. And the only way I can explain it, because it makes no logical sense between the GDP and the economy as a whole and what's happening inside the economy, it makes no sense unless like we kind of factor the herd out when we look at things logically. But when you look at why prices skitter or why prices really go erratic, it's the herd. So for whatever reason, the herd is panicking and it's getting displayed in the bond market. We saw it a little bit outside of the bond market too with US stocks, but it seems like the herd is panicking over the amount of debt the United States has. Now, I know I'm not saying anything different than what you already know. We have a lot of debt. So I don't know why the herd itself hasn't figured this out. And I can't wrap my head around it. Like common sense and logic do not apply to the herd. But you'd have to be like living in a rock in the middle of a quarry at the bottom end of the limestone, which is how many thousand feet deep, to not know that the US is trillions of dollars in debt. And the herd, honestly, I didn't think the herd was that dumb, but I can't make sense of it. So, I mean, yes, the herd is panicking over something, but for us, it's a gift. I mean, I don't want to see my stock value go down. I don't want to see my portfolio value go down. But when it dips for any random reason, I mean, hurt or other, when it dips, you buy the dip. Um, and of our targets, so if we're looking at bonds, bond proxies, we're looking at energy transfer, and we're looking at US stocks. When I look at my portfolio, and then when I look at the existing price of things, it looks like what we have, the energy transport side of things, are kind of near their recent peaks in the sense of they're still climbing back to where they were prior to COVID. But if we still look at the chart, but if we step back a little bit and think, it's still very early in the AI party things, or in the AI party of things. If and like everything else, like yes, we sell it as this golden age, but AI doesn't run on magic. Like it's not Stardust, and it runs on energy and it runs on infrastructure. So we want to be early to that party, and so I get that the transport numbers, or at least the stock value, is kind of at their peak, but in getting there early to the party, I think those numbers will continue to climb because we need more utility, we need more energy. And that means more hubs, more pipeline, and more data center, right? Like if we're going to run natural gas to all these new data centers, we're going to have to build a lot of energy and more utility departments on its way there. And then when it gets there, we're still going to have to cool down data centers. That's just more utility work. So we're early to the party, and the prices are, yeah, they're high compared to where they've been. Like I looked at KYN and NML both today. If we bought 100 shares at current value, I think KYN would raise our overall average price maybe 70 cents, which in the grand scheme of things is not a ton of money. But it kind of looks that way when you're only looking like through a very small tunnel. Like, wow, that raises my value, like my average buy-in value a lot. Like I would much rather buy it cheaper. That's true. But on the upward slope of things, when we're just going to start pumping more energy around between oil and natural gas, We're not buying the supplier. We're not buying the consumer end of things. We're buying the middle, and the middle is what's needed. So besides bonds and proxies, besides energy transfer, US stocks remain a decent option. They remain a solid option, but they remain a decent option. And in that vein, I hear a lot of chatter, I read about a lot of chatter for US stocks because the US dollar is weakening. There's fear of a recession, there's fear of that expanding debt, even though we've had the debt for years. But I don't see the weak dollar aspect. Like I get that's what I get that's what the herd's hearing, but I don't see that in reality. I think the dollar is stronger than most people want to admit because the US economy is humming. GDP is growing and jobs are strong, even with AI reshaping certain workforces in the sense that Meta itself is not hiring people. They're continuing to expand AI. So they're on a business end of things, you're trimming what's weighing down your profit margin, people. You're expanding AI, making it more efficient and cheaper. You're keeping your current employees, so hopefully you're paying them more, maybe not, but that's having an impact on the job market. The other part of the job market that nobody wants to talk about is illegal immigration. You have tons of companies underhandedly or undertably paying illegals to occupy jobs for Americans. And as those people are removed from the country, it's dinging the labor numbers. It's dinging the jobs numbers because you are paying those people for a job. But since they're not citizens, you're paying them less, which we can get into the nefarious aspects of business later. That's not my point today. So by removing the illegal populations across the board, yes, construction, but also industrial and really across the board, there's going to be, we'll say, opportunities in the job market space. And maybe they weigh the job numbers down a little bit. Maybe. We're going to find out how many companies have been hiring and employing illegals. If all of a sudden the unemployment number or the gap of employment, not so much that a lot of people are out of work, but that a lot of businesses need employees. We're going to see how bad that gap gets, and that's going to tell us how bad or how many companies have been employing illegals over Americans or illegals over citizens. That's going to be interesting. So, but back to the dollar. So, yes, the economy is humming, GDP is growing. I still think jobs are strong. Oil production is up, natural gas production is up, which is why we want to be the middleman. You can buy the supplier, but right, but pending administration, the supplier is either on or off, right? Somebody flicks a switch and the flow changes. The consumer is always needed, but it's still regulated by supplier. We want the middle. So we essentially want the toll bridge of energy. So let's see, oil is up, gas is up, or natural gas is up. Tax cuts, there we go, aren't going anywhere. Those are fixed and in place, right? And there's this growing sense of what we have talked about and known, but it's being whispered and openly talked about in other places that the Fed has been manipulating us for years. And that's finally starting to become more of a popular topic in that kind of like sandbag, I guess you could say, is finally starting to kind of trickle out where it looks like maybe somebody not so much slash the bag, or at least the bag has a hole in it, right? The US itself, I believe, is standing at the edge of greatness, but most people categorize the edge or they paint that picture as a precipice, right? And we are positioned to rise into a golden age, the golden age of technology. You can say it's the golden age of AI, right? That we've talked about. There's great things with that. There's bad things with that, right? Because at the heart of things, there are people that are great and there are people that are not great. But we're at the forefront of another technological revolution, and the US is poised to lead it. So though we're at a precipice, I still think we're on the bottom of an upslope, not so much a cliff. It's getting painted like a cliff. The herd thinks we're going to fall off this cliff and the world's going to end. And it's not there. It's like I wish I could change that optical illusion in their head of what they're looking at, or at least shatter the glass through which they're looking, because it's not an edge, it's the upslope. So, and about that ballooning debt, that TV screen pushes fear. It pushes calamity. It pushes destruction, right? If you think of your local news station, do they show things that are good in your area? No, because they profit off the other stuff, right? But what they're not telling you about, kind of in that vein of good, they're not telling you about the external revenue service. We have trillions of dollars flowing in over the course of the previous administration. In the course of 4 years, only $1 trillion was invested into the US. That's that's a number that still boggles my mind. Like I can't wrap my head around that number, that it's that low. But if you look at what's coming into the country now in 8 months, foreign governments, foreign businessmen, US businesses, right? People inside the US, in the last 8 months alone, actually over $17 trillion have been invested into the United States. Manufacturing, but also just invested into the United States. You have companies committing to building manufacturing in the US. That's huge for the US. That's also huge for local communities. That's huge for local jobs. It's a very different economy than it was 9 months ago, but we're also on the forefront of that economy. So there's great things happening. I'm seeing changes, but I'm also not seeing all the changes that I would like. But I can feel the current and I can feel the tide in the general population shifting. I think the Federal Reserve is late to the party. They cut interest rates and they fell flat. I mean, they made a big deal about it. The bond market didn't like it, but they belly flopped. They got hurt more than anything because honestly, they could have cut it 0.5%. They could cut it a percent next month and the economy would just keep chugging along, right? If anything, it would inspire people to spend more, even though we have all that debt sandbagging. So the the logical, common sense, disciplined person would say, I'll take advantage of that and pay off my debt faster. But that argument, well, we could spend a lot of time on because not everybody has common sense. That's also the reason why we're sandbagged with debt. But that's the ERS too. The ERS's job is to pay down the debt. The ERS's job and function is to go around Congress and not have them spend the new money like a drug addict at a cocaine party, right? The job of the ERS is to take in tariff money and pay down the deficit. That's huge news because now Congress can't spend it. We can actually shrink that debt. That'd be amazing. But they don't talk about it because it blows up their narrative, right? Fear sells, but also that fear pumped into the herd, as much as I dislike the herd controlling the market, and as much as I wish the herd itself would learn. Like I have empathy for the herd. I have compassion for the herd. I wish I wish they would learn and do things differently. I really do. Like for the good of themselves. We would love a more consistent, stable market. But for the good of themselves, I wish they would learn. But for the most part, they're not. So whether they learn or not, I still say we use that fear opportunity and take advantage of it. So I'm looking at I would look at bonds and bonds proxies, especially the ones that for whatever reason took a hit last week. I think we look at utilities and energy transfer, and then I think we look at I think we look at AI focused or AI aligned portfolios that have a great blend of US stocks. Now, that being said, every single company should benefit from AI, but it comes down to purpose and how the company's using it. So it's not just we should invest in any US stock. I think you look at the blue chip giants, the companies who've been around for a while, and they pay a sound dividend. But on our end of things, we're not buying the individual companies; we're buying them as a package inside a closed-end fund. And on my end of things specifically, I like companies who focus on targeted investments. If they're managing it, and I get their purpose, like if you're managing a portfolio of 800 different funds and your competition is managing a portfolio of 100, I generally lean towards the 100 because it's focused money instead of money that's spread out. But it also comes down to manager, it comes down to business. Like there's more things than just the diversity of your stocks or the diversity of your portfolio, for sure. But if it comes down to me, if I'm going to buy, if I'm buying name brand, which I generally do, right? But if I'm buying name brand, I'm more likely to pick a brand that has targeted investments instead of something that's spread out into a lot of different things. So it's not just that we're buying US stocks across the board. We're still prioritizing what US stocks and what tech stocks we're buying. So it's the honestly, it's the same list of stuff we've been talking about. It's just a slightly different order. Like outside of the bond dip, I might have said AI and stocks, energy transfer, and then bonds. But with the AI dip, or not the AI dip, but with the bond dip, we buy the opportunity. So let's get into the list. And I'll be honest. So of the stuff that's still on my list of stuff to do, let's see, where's my share screen? Make sure I share the right screen. Share. So of the entire closed-end fund master, everything got updated this weekend, finally. Of what's still on my individual list to do, and what I can share. It's twofold. One, I have to update the Roth. OXLC, yes. Did a reverse split in consolidated shares. I talked about this a couple videos ago. I still have to update it here. The other thing, I've emailed, let's see, I have emailed, social media posted, and posted inside the app with Webull. And I've emailed their managing firm, Apex Clearing. No one has emailed me back. So it's like they're holding my Roth account hostage. Talking with my tax guy, uh, Webull charges a $75 transfer fee. I really don't want any money leaving my Roth because of any kind of tax issues. But in talking with my tax guy, I can get Fidelity to transfer that out. If Webull takes 75 bucks out, Fidelity will pay me back. So long as the money's back in the account by 60 days, I'm fine. That's a headache. And initially, I didn't want to, like, I enjoy Webull. I actually like their system a lot better than Fidelity. I like it a lot better than Morgan Stanley. It has a very friendly, user-friendly system. But we're trying to get everything under one umbrella, and Webull didn't offer everything we needed. So, I like parts of Webull, but in this issue, their customer service, you're essentially holding my account hostage. It's like you've kidnapped my money. I can still get to it, I can still access it, but you won't return my calls. It's like you don't even care. And they can I get you want to keep my account, but you're also intentionally distancing a customer. It doesn't make sense to me. So part of my job is to move the raw from Webull to Fidelity with everything else we have set up with Fidelity. So I've got to update the one, update the Roth, two, move it to Fidelity. And then on the Fidelity end of things, I've been waiting to add the USA ticker down here because I could make a how-to video of how to update the portfolio and then how to update. Sorry, I don't know. I can't spin it, and the animal's gone. But there's a gap between our front foliage and our window, and it's like a highway system for anything. Cat, raccoon, possum, like they all end up just kind of making a brief appearance they go along. Um, but yeah, on the fidelity end of things, I want to make a video on how these spreadsheets communicate, of how I update the scheduled or the projected dividends, but really how the real-time dividends connect with the spreadsheet so that all these different, not those, all these different dividend percentages and dividend payments come in and work together. Um, so several things to do on this front, but that's still not all the stuff I got to do. Um, the raw stuff's good because I've been trying to figure that out. So at least I got stuff like I have a game plan. I can finally follow through on the fidelity stuff. It'll happen. I'll make the video and we will move on. But the master itself, the master got updated. I moved all the triple asterisks into this list for the week. And this is what we're focusing on. Really, these are kind of the same things at the moment. There are some new tech firms, but it's really companies that are solid and they're going to weather anything, blue chips. Uh, Bonds and proxies, all of these companies, all these different subsets of the market, right? So bonds, but then munis, municipal bonds, munis, loans, business development companies, utilities, collateralized loan obligations, and real estate are all proxies of the bond market and kind of trend the same way. So between like bonds themselves, and then as we look forward into the coming or kind of the ascension of the golden age of technology, or at least our version of the golden age of technology and AI, real estate is going to be a huge part of that between commercial properties and industrial properties. So it's not just energy transfer in the sense of who owns, like the company that owns this one pipeline. It's that company is also going to be building more pipelines. We're also going to have companies building data centers, right? And between the industrial work and the energy work and the data center work, it all works together. So, of how I would sort this out, well, generally it's a rank by category. I like monthly payers unless there's a good reason to look at something different. And I don't know if there's a good reason at this point with with on my end of things, and your end might look different. With limited investment, it's not like I can buy everything. So in order for me to buy something different than what we already have, it's got to be amazing. So like DX is great. It sounds great. It sells covered calls. It's probably, let's see, the description was it's a great time to buy in low volatility. Does it because it does exceptionally well in high volatility. That makes sense to me. But on it, but despite it being a significant discount, it's not my favorite payer, right? Because it pays quarterly. It's also kind of expensive in the grand scheme of things. So it gets the easy axe. I'm not a huge Aberdeen fan. Like I've owned their funds in the past, several different funds in the past, not a huge Aberdeen fan. And that leaves these two that we already own. ADX currently is kind of riding a high. Let's see. Yes, this is our actual portfolio. So ADX 2211, a little bit higher than where we bought it, not bad, but it's going to come down to price, right? So if I'm going to prioritize bonds and their proxies and energy and energy transfer, as much as I like US stocks, if I'm going to buy, if I'm going to get AI and blue chip stocks, ADX and USA are both great, and you can argue for both. I mean, you really can. You can argue well for both, but it's still going to come down to price. And ADX is like 3 times more, 3.5 times more expensive than USA, and you get a better dividend with USA. So you can be the judge of that. Currently, they're both great buys. Currently, they both have really great targeted portfolios. ADX's history, God, the USA's value does tend to do what like it grows over time, but it does tend to do this. ADX at a glance on the history of things, their portfolio just goes. So you're getting this long-standing history of management, and they know what they're doing. So maybe they both stay, and it comes down to you of what you want to do. So after dividends, we look at, or sorry, after category, we look at dividends. The CLO market, is sketchy as the herd is, the CLO market is its own subset, and that batch of investors as a whole are touchy at the moment. Like it's like that squirrel on Ice Age. Like they're like the herd, but it's like a, I don't know, like a scatterbrained herd. It's crazy. The risk of default is super low, but currently in the CLO market, people are fearing default. And I don't, it doesn't, like, I have no fear of default, but the herd fears default because of what they're getting told. And it just doesn't make sense to me. They cannot rationally think on their own. So on my end of things, I would buy more of OXLC. But since they just reverse split to try to control their numbers, you know, you could get their fund at like $3, 350, and now it's at 16, 17. That's pricey. Um, so like thanks for the reverse split, but at the same time, no thanks for the reverse split. So we'll keep it. It pays a fat dividend, but at the same time, that market space right now is really touch and go and really crazy. So CLO on its own, I think I found one option that's decent, but it's still in and of itself. It's a like Eagle Point. Eagle Point's interesting and not be, yes, it pays a great dividend, but we're looking at company overall. They seem to be in a great spot, but at the same time, I don't mind walking alone by any means, but the CLO market space right now is extremely volatile, uncomfortably volatile. And not that whole like get comfortable with being uncomfortable, not that. Like, yeah, my default fears are not that bad, but you're dealing with the herd. So could I leave any on the list? If I was going to do this for me, like if we're going to play the bond and bond proxy, I would buy more bonds and not proxy. It that's not, I mean, that's not a good way to say it. So I would buy more, I would focus on municipal bonds currently. The three we own, they slightly decrease their dividends, but their prices right now are a lot higher than where they've been. Loans kind of get lumped into bonds. I would buy bonds, BDCs, utilities if you can find them cheap, and real estate if you can find it cheap. In theory, all of them will trend like bonds. So the dip in bonds should have impacted all of them, but it didn't. Uh, the real estate we currently own is slightly higher than our buy-ins. In the grand scheme of things, not a big deal. Utilities are slightly higher than where we bought them. In the grand scheme of things, if they fit the metric, we could buy more. Municipal bonds had the slight dividend decrease. Pricing wise, they would be a dollar cost average, but at the same time, we're paying more for them than what we would buy, what would be what excuse me, than what we would be buying in bonds. So if it's a I don't want to say a penny pincher, but if you're really trying to isolate best buys with an established fixed limit in your money bag, you're going to have to be stingier on what you buy. Like we're trying to make every single cent count, not so much every single dollar. So you can't buy everything. You also, from my standpoint, don't want to buy everything. It's butter scraped over too much bread. It's diversity for diversity's sake. If we're doing targeted investments, we need to target investments and not like spray it with a machine gun, but just spray it with something, spray it with a laser or a water cannon or fine, a rifle. Like it can't just be like fire everything and hope something lands. We want to fire at a specific target, knowing it's going to get hit. So me personally, the CLO market is too up and down right now. I'm fine buying on fear, but it is way too erratic. If I left anything, I would leave Eagle Point. Hicks Hicks has been hitting the metric in the sense of it. The existing discount is double the historical and greater than the 5-year average, but it doesn't beat the market. So it when I started this list, I thought I would trim it to stuff I would buy and stuff that wouldn't keep my attention. But instead of doing that, I just put everything that meets the metric on it, and then I just tell you about it. And then if you like it, you like it. Let's see. River North does have a municipal component, but it's got a heavy BlackRock investment, and that's not me. NMAI has that U.S. to foreign ratio, but that's if I'm focusing on U.S. investments, I'm getting 50% foreign portfolio, and that's not helpful for the solid U.S. investment. Aberdeen Destra changed their dividend from annually to monthly. That's interesting. Um, there, it's a portfolio in a can based on Morningstar, but at the same time, it doesn't read like that on their description. So yes, a multi-alternative investment, but really gray on how that works out. But on my end of things, I don't like outright portfolio in a can in the sense of we built a portfolio in a can. Just doesn't make sense. It's the diversification standpoint. Like we wanted to have funds in every category just because we could have funds in every category. That being said, Morningstar categorizes stuff sometimes like that, even though it's not that way. Sorry, critters on the side. All right, so USA State. CIF is a great roller coaster ride, but not something I would put in a portfolio. Like we're trying to build portfolios that last. That's not to say we're not going to have stuff that rolls in and out. Um, but I bought CIF on a roller coaster ride, knowing it would be a roller coaster ride. And while it seems to be tracking like so with lower rates, the cost of the fund should rise. But at the same time, the roller coaster ride itself is not something I want to repeat. I'll put it that way. DLY would be different. We own the sister fund. but at $15, it's kind of pricey right now. TEEF, 80% of all solar panels come out of China. The US and China tariff tiff is back and forth. TEEF itself has taken a hit. At sub 12, it probably is a great idea, probably is a good option. And I've said this before, I like solar and hydroelectric for use in rural areas. If you want to put solar panels on your house, whatever, just don't force everybody else to do it. Um, but their portfolio and their company structure is built on we love renewable energy, we hate oil. But what they don't tell you is it takes oil to make all of their products. So it doesn't make sense to me. The investment in TEEF is it's a term fund. I think it expires in 2031. Yeah, 2031. So you buy it at 1165. Whenever the term ends, you receive the value of whatever its net asset value is. So you buy it for 1170 or 11, yeah, 1165. You collected 9% dividend until whenever you sell it or the company liquidates, and you get like an added bonus for having owned it on the back end. But at the same time, I just have a hard time with their business concept. I've looked at Eaton Vance in the past, um, but portfolio structure wise, and I've talked about it in the past, they carry a ton of funds, and that's not a bad thing when you like the safety of diversity. But I like funds who invest in targeted investments. So if I'm and I've looked at these funds, I forget what I forget the specific numbers. So at one point, one of these funds had almost 600 different companies they're invested in. US companies specializing in AI, using AI to their benefit. Well, instead of doing that, I can buy ADX, who is invested in less than 100 companies that does the same thing and has this phenomenal track record. So I think if you bought anything following the tariff dip, you're probably in a great spot. Currently, Eaton, like I've tracked Eaton Vance for a while. It's interesting to me. But if I'm going to pay this much for a fund, I'm going to spend it where we already own and not pick up something new that does something that like in order for me to pick up something new, it's got to have something or do something differently than what we currently have and do it in a much better way. And portfolio like double DLY has a different portfolio than DSL, but DLY is pricey. TEEF won't fit the bill. Eaton Vance, it's different than what we already have, but it's not better than what we already have. RLTY might be either comparable or better than RFI, what we already have. But this one's on discount. Now it's not as much discount as it's been. It's more than it was last week, right? With the little dip. But it's not as much as it's been. So 5.5 is better than the 1 year, but not as great as the 3 year. It's a decent buy. I mean, it's a much better buy at 15.15 than like 15.80. But in relation to everything else, it's going to be almost double of some things. So I could keep it on the list for now, but it's probably not going to stay. ADX would stay as an option. Calos is very similar to Eaton Vance. They seem to run great portfolios, but I don't know if it's necessarily better than what we already have. Saba used to be a lot of government bonds, but that last time I checked, it doesn't seem that way now. Yep, Newberger, I like the fund. River North, excuse me. Yeah, not completely tax free. Still BlackRock. That's not my jam. KYN is energy transfer. HFRO is real estate. UTG is utility. But yeah, if 15 and 22 are high, 38 is high. So that leaves me with this. Um, and you can't buy everything. I mean, you can, but then you diversify and then you don't get much for it. So I can't buy everything. So if I'm going to focus, I was thinking about this earlier, if I'm really going to focus and streamline or strip this down, then I have to let CLOs go. BRW we already own and it dipped on price. FSCO, it dipped almost $1 on price. HGLB is running high. USA is a little bit below where we bought it. And we bought it in this one because I earmarked them. USA 647, right? A little bit less, pretty much on par. RLTY is more than at $15, it would be on the high end. ADX would be too. We own 100 of USA, I think, and 100 of ADX. Would I like to add them both? Yeah, but you don't have all the money in the world. And if I'm gonna buy, honestly, if I'm gonna buy these, right, so like $21 together, it's gonna be hard to do 22 here. Uh, NML, yes, it used to sit, its previous normal was 8, but it's since risen. So NML and KYN are higher than our current buying average. So it would come down to purpose. So if I'm trying to look at the bigger picture, like, and not just my immediate picture, right? So the bond market dipped. I think that's an opportunity we shouldn't pass up. I think it's an opportunity I shouldn't pass up. But if I look at the coming market and where AI is going, energy is going to be huge. And it's a needed, we're going to have to generate about, what state did I hear? Like Texas itself is going to have to increase our current energy production levels by almost 50% in the next 5 years, I think is what I heard, which is insane. And it's the same trend nationwide. So the nation itself is going to have to boost its grid considerably. That's going to take a giant infrastructure project. That's also going to mean like all the technology to build that and the oil to build that, and then the utility center to manage it and the data center to manage it. So it's pricey, yes, but it's not like I see that price dipping. The price of oil might dip because we're pumping more of it. If we're increasing the supply and the demand stays the same, right? We want that price to come down. Natural gas, we're going to have to increase supply because more people are demanding it. If we exceed, the price will drop. But if we target the middle, right, we need that product sourced from where it is, taken to where it needs to be. All of those pipelines ought to be busy at least the next 3.5 years. So I would much rather buy the middle, and I really want to buy the middle before the herd gets there. So I get that it's on my end of things, it's pricey compared to where those average buy-ins are now. But I don't see that price decreasing anytime in the near future. So that's tempting. The other part of ADX's portfolio is they have a natural resources portfolio. So they have the producer side of things. They also do have some energy transfer side of things. So that's that's also where it's different than just owning USA. And NBXG it's a 5G powerhouse. HFRO is all real estate. It's a great deal based on discount. It's risen since we bought it, but it's also it, on my end of things, even though it's got a great price point, like a great entry point and a great discount, on my end of things, it's not actually the best buy. HFRO has healthcare, storage, rental homes, single family homes versus RLTY is commercial real estate and industrial real estate and also data centers. So HFRO is tempting because of price, but it's not quite the best buy. So then how do you streamline the rest? And to be honest, I don't know because it's all interesting. So if we prioritize the bond dip, right? And so I just made it to where whatever that starting point is subtracts all of these and gives me this final number, right? So if you want the formula of how to do that, you hit equals for this box, then you single out that one box minus the sum of these numbers gives you a final number. So if we're gonna, let's see, BRW and FSCO, BRW slightly higher than our current buy-in, right, or average price of share. Not going to trigger that too bad. FSCO 680 compared to 659, like that's a steal. So if we're going to prioritize these two, that only leaves so much money. You can't buy everything. And as tempting as stocks are, like USA on a dip is a great deal. But it's hard to buy ADX knowing I also want to buy the other stuff. We haven't bought these two companies in a while. That means like nothing else here. Let's see what that looks like. Yeah. So if we did it this way, we'd have to either I mean, we could pick up 50 shares. What I would have to do is compare RLTY to RFI and do a little more digging. They pay a consistent dividend. It's only been around 3 years, I believe. Yeah. And it's 6% off. It's a pretty good deal. RFI rarely comes on discount. And I would have to see if RLTY really gives a better option than what we currently have. The difference is, I mean, of the real estate funds we own, HFRO, which has gone up in price and shortened the discount, IGR, which is currently in premium, and RFI, which doesn't meet the triple asterisk, they deal in different levels of realty. HFRO is very Texas based. RFI is really North America focused, and IGR is worldwide. RLTY and RFI have very similar portfolios, North America based, US predominant. I would have to see if that one portfolio has a significant difference between RFI and if it gives us something different that we don't already have. And if it's extremely similar and pretty much buying another portfolio and giving me like, oh, I can buy it just because it has a discount, that's really not that good of a reason. Um, yeah, and 900 wise, so if we go back, there we go. So that would look like this. Yeah. ADX, would it be great to pick up another 100 pack of ADX? Yes, for sure. Um, it gives us similar to energy transfer. It gives us also energy. It also gives us AI and US investments. So it kind of targets all of them outside of just bonds, but it's the cost and it's the quarterly payer. And I love a monthly payer system. So we can get essentially like direct connect energy, or we get more energy transfer. Um, it's a great idea, but you only have so much money. I mean, we only have so much money. And then how it breaks down a month, I mean, because that's a quarterly payer, it's not going to pay another dividend until January. We would get another 44 a month. And that's the other part of it. So USA, to buy USA now, they don't go ex dividend until November. You don't get a dividend until January. That's not really a great deal, right? You get it on great price point now, but it's not really a great deal. So I would almost rather do this. I get that it's 130 over, but you're also just watching this. It's two things. One, it's watching the value to see what the value does in the opening day or two. And on the other end of our end of things, it's seeing, so it's our current cash value in the account waiting for our dividends to come in. So if our dividends come in and it's more, then we would have enough. Just depends on what the final number ends up being after the slight dividend change in those three municipals, which I don't think is going to be that much. But at the same time, we'll see what it ends up. So you can only do so much with what you have. We're just trying to do the most we can with what we have. So we'll see how it goes. We really will. But if I had to pick it today and I was buying tomorrow, I I would not be able to get ADX because I just don't have that full amount in the account. If I wait till the end of September, then I think this is what I do have in the account, and then I would buy this pack of funds, including ADX, uh, simply because I think ADX will go ex dividend in November. I don't really want to wait 3 months until I get a dividend in December, but that'll still pay me before USA will. And to buy AI, so you get US investments, you get AI, you get a huge, but which technology, yes, but you also get another. It's AI itself, but it's also all the microchips and technology itself, and you also get the natural resources factor. So, and I get it's waiting 1 month, but at the same time, yeah, I would pick that. So I would go with this subset, but it also depends on what we have in the dividend or what we have in dividend cash when September ends. So if you found the video helpful, which would include all of my ramblings, if you found value in the video, you found the video helpful, hit the like, drop a comment, and help me hack YouTube. The more interactive each video is, the more the YouTube algorithm wants to put it in front of other people. And I want to help people learn there's a better way to invest in the stock market than the traditional buy a single company and hope the value goes up year over year. And we want growth, but I also want to buy stocks on dividend. And I also want a much better dividend. I mean, the S&P 505 average dividend is like 1.2, right? Our portfolio pays 10. So, and we get paid monthly. Most S&P stocks pay quarterly. So there's a better way than the traditional investment strategy. So if you like the video and share the video and comment on the video, that tells YouTube two things actually. One, it tells YouTube you're involved in the content, so it helps your channel. And on my end of things, it helps my channel because it pushes the video out in front of more people. So maybe instead of just help me hack YouTube, we can hack YouTube together. Um, let's see. I'm hoping to get some on my end of things for the week. I'm hoping to make progress, considerable progress. We'll see if that happens. On your end of the week, or I guess on your end of things on your week, I hope you make progress on things, right? Where we, regardless of purpose, whether finances or anything, the goal is to make daily progress and make progress by the end of the week on everything. And that doesn't mean you 100% finish it, but that just means by the end of the week, you're further ahead than where you were when you started. So wherever you are, whatever you're doing, whatever you're up to, I hope you make progress in your projects this week. And if that's the market, I hope this video is helpful. And I hope you make some progress inside your portfolio. So if you have questions, by all means ask. If you're interested in the Substack, you can go find it. It's the same handle, Adaptive Perspective. There's just nothing there yet because I haven't added anything yet. But if you have questions on the market or about the 12 steps to financial freedom or about anything else for that matter, just tag the video and I will respond. So I hope you all have a great week. I hope you have a successful week. And whatever you're up to, I hope you make progress. See you later. Bye bye.